Mark, we've been talking all morning in the last hour or so about what the bull case for Europe actually is. Is it cheap enough to own at the moment? Your view?
I think the long-term bull case is still not very exciting, but I think you've hit kind of nail on the head there, Kriti, that it's the negatives are largely in there. It's very, very discounted. And remember that we're trading this week a very positive macro tailwind. The big bad wolf of very aggressive tariffs has not been delivered. It's not been delivered anytime soon. Sure, it may come in the future, and that means that risk assets can rally. They can focus on the fact that earnings are generally good. So I remain positive stocks generally, globally, and I think the discounted ones, the ones that were pricing in perhaps a new world that was all about like US companies, I think probably incorrectly so, are going to gain the most. That's why I think that many around Asia, Europe, they're the ones that can gain. It's really important to emphasize, though, that while I'm painting this very, very positive picture, I don't think this is a long-term one. I think it is a window that lasts for a couple of weeks. Yeah. We're still going to have a volatile new US administration, and we still have expensive valuations in the US. So this is not about aggressive bullishness, but it's that we've got a window to be positive that lasts to at least the end of next week. Let's see how much longer.
If you look at the options market, there's not a great deal of call buying at the moment. This doesn't feel like a market that's being chased. Does that kind of, how self-limiting is this rally if the market is waiting for more bad news? How far can it really take us, and how convinced do you think traders really are about it?
So I think this ironically makes it more sustainable but less powerful. You're absolutely right that people are kind of going, yeah, we've got no tariffs now, but they still could come at any point, and things can change quite rapidly. And we already have expensive valuations for a lot of US stocks in particular. So people are not going to get enthusiastic just because we're given a relief window. But it's actually because that people are nervous out there. We don't have excessive positioning. We don't have excessive bullishness out there. We saw that from the sentiment, the AAII sentiment survey only a week or so ago, that the bullishness had suddenly dropped despite stocks being near the high. It's because of that nervousness that I think that we keep on kind of grinding, to slightly higher highs, despite the fact that we don't get any ebullience out there, any effusive bullishness.
Let me ask you about Chinese stocks, Mark. We've heard some initiatives from various regulators over in China trying to get more pension money, insurance money into Chinese stocks. The bounce as a result of that was pretty short-lived. We are still positive on Chinese equities, but only just. But it did deliver a sugar rush to markets. Do we view this in the context of, now we're in the Trump presidency, now China can start to unleash some of the measures it's been keeping up its sleeve? What do you make of that news flow?
I mean, first of all, you're right, Anna, to make the point. I'm going to repeat it. It was pretty underwhelming reaction out there. I mean, this is a market where there's a large retail participation. It would be hoped that this kind of institutional boost would make a difference. But it is, over a long period of time. It's not going to necessarily be an immediate impact. I think this is just yet another measure, which we've seen many over the last 4 months now, of trying to a marginal measure to stabilize the market. And I think it's the same story. Look, this is a market that's up about 25-30% over the last 4 months, and that's the idea that it's not going to keep on going on up at that pace. And in fact, this is an economy that has structural problems. They are now acting very aggressively to counter those structural problems. But this doesn't get us back to the old school China bull market that people really, really want. It gets us back to a market that's probably going to return better than average returns. It's probably going to be an overall good investment, but it's not going to be an exciting one. And there'll be something else out there that beats it. But if Chinese, Hong Kong stocks, if they can return 15% this year, that's a good return.
Well, Mark, when it comes back to European stocks, what is the bigger read-through? The headline risk you get out of the United States, or perhaps some of that fiscal stimulus read-through from China?
I think it's still going to come down to America. I think that's the more important one at the moment. As I said, I am very much in the camp that we're probably not now getting tariffs maybe to April. It's still likely tariffs are going to come through at some point. We've got the new arm of the US government that Trump's setting up to collect those tariffs. We know he's in favor of tariffs. We know they'll likely come. He might even impose them just temporarily for negotiation points. But we know tariffs are likely to come at some point. On who and at what level, we don't know. And what sectors, we don't know. And I think that is ultimately still going to remain the big story for 2025, even if it's not the story this week that we thought it would be. So I think that's still going to be the biggest driver for Europe. The other issues for Europe is that, as I said, in the stocks market, much of the negativity around European growth is priced. It's a valid negativity. It's not like Europe is suddenly a bull story. European growth is problematic. European debt problem is problematic. European politics is very problematic. The German election, people aren't really focusing on that enough. What was happening in France around its fiscal situation, I know it's not an election anytime soon, is also problematic. So I think we've got many problems in Europe, but much of them are in the price. And therefore, this is just a short-term relief rally. And ultimately, it'll be more about what happens out of the US this year rather than the China fiscal story, which is going to support, it's going to help Europe, but it's more about stabilization. It's more marginal. It's not a new super bull market.